let's talk about automated trading, because I think automated trading generally gets a bad press. Most of the headlines you see around HFT or automated trading are generally pejorative. And I'm not sure I agree with that, having grown up with it and having worked at automated trading firms who have been at least referred to as HFT firms. So if I went back through the history of where automated trading came from, might give you at least a better idea of what the industry looks like now and a better viewpoint. So to begin with, why do we ever make a trading decision? And an easy way to think of it is you're either going to take risk or you're going to mitigate some risk. So you either believe that something will happen, whereas if you put some risk on, you can benefit from that, or you have some risk, you've taken out a large loan and that's a floating rate of interest. So you can enter the derivatives market to get rid of that floating rate and take on a fixed rate. It allows you to plan your business better. So you're either taking risk or you're mitigating risk. Now, all that now needs to happen is that you need to find the best price to do that. And so that price discovery used to happen from the early 80s up until 2000 in a pit, on a floor. Lots of big men like John and others who could stand higher than other people and shout louder and make crazy hand signals on the air that they were buying 5 or selling 5. Used to happen in these pits, and they were very full of shouting and abuse and testosterone. But they were great fun. Late 90s, early 2000s, that started to go away as it was realized this was actually a very expensive way to discover the price of the thing that you wanted to either take risk or mitigate risk with. So some of that activity started to move to screens. Now, what happens now is that you remove the advantage of how big you are and how loud you can shout, and it starts to become a very different thing. It starts to become much more democratic. Now, that sounds like a good thing, and I believe that it is. It wasn't felt that way for a lot of people because they were disintermediated. Now, if you're a bank, part of the sell side, and you have clients that you can provide pricing to, but you can also provide financing to, you can also provide research and information to, that's a great business to be in. If now, instead of your price being the price that your client trades on, he can see that price on a completely transparent screen, which is available anywhere in the world, and other people can make better prices than you, that ought to be a better result for the end client. So you'll hear a lot about disintermediation and a lot about democratization of markets that automated trading has done. And for my money, that's a good thing. Generally, the people who don't like that are the people whose business has been more competitive because of that. So what does automated trading do? It's the same thing. It's all about price discovery. So whereas before a few hundred people would stand in a pit, and in the end you might be paying 10 and selling at 20 and get down to a price of 14, bid at 15, and you'd work out the price was somewhere in between those. That happens very quickly in an electronic screen. But of course it does bring its own issues. Whereas before, in a pit, you could see who you were trading against. You could build relationships with reliable trading partners. You'd know that if you needed to, you could lean on someone to help you out of a position that you were in. That happens much less in an anonymous, electronically traded market. So you might think of the benefits being better pricing and more transparency for end users, and the disadvantages of worse relationships with other market participants. But that democratization should bring newer and different and a broader spectrum of market participants to the market, all of which should give better prices for end users. So now we have fully electronic order books and hardly any pits left anywhere. If you want to see them fully in action, you'll need to go to Chicago probably in the next couple of years. There are only a few pits left there. Mainly for option strategies, which tend to be more complex and lend themselves more easily to a pit or somewhere where you have relationships with people. There is also still a trading floor here in London. It's on the floor of the London Metal Exchange. It's slightly different to the old original pits here in London at Life, where I first started, and in Chicago, where I've seen them. It's more of a price for the day, to settle the price for the day, rather than where the trading happens. That tends to happen on the phones or with brokers. So there aren't many opportunities to see. If you get the opportunity, I would advise that you take it. So with all of those screens gone, and most of the major markets now, the pit's gone, most of the major markets operating on screens, there are different problems, and a lot of the headlines you see about automated trading refer to predatory HFT and spoof liquidity. I think all of the abusive practices that are attributed to automated trading are not new. If you front run a client order on a screen, you used to be able to do that in a pit. If you wash a trade where you put something up there where there's no economic interest in doing so to give a false or misleading signal to the market, that used to happen in a pit just as easy as it can on a screen. There might be slightly less personal accountability now, and that you can't see the person that's doing it. But of course, there's a very clear audit trail of accountability, because every single electronic order is tagged with who did it and when. So yes, there are abusive practices in markets, and yes, much of that is electronic due to the fact that's where most of the trading happens. But I don't think electronic trading is to blame. Abusive practices have always been there. So the last point I wanted to make was in regard to that, when I say what is HFT. Bear in mind that I used to work for an exchange many years ago where apparently high-frequency trading firms existed. I also worked for the UK national regulator. One of the obligations is to investigate market abuse, and some of that surrounded so-called high-frequency trading. And before my current role, I worked for a firm, one of the ones that one of the other Steves mentioned, that is widely dubbed a high-frequency trading firm. And I don't know what high-frequency trading is. It doesn't make any sense to me. I know what automated trading is, and I know that some of the strategies in trading might be improved with lower latency. For example, if I'm waiting for a signal on a German exchange to execute on a US exchange, if I can get that signal quickly and before at least some of the other market participants, I can execute on a US exchange. Well, that's low latency. But I might not do that many times, so therefore it's not high frequency. So I've never really understood what the term means, and you would think that I should. So if you know that trading happens because people want to take risk or people want to mitigate risk, well, that's a trading decision and that's a strategy. Now how you execute, how you discover what the price of that instrument might be on an electronic exchange, it doesn't follow to me that you would do that in a high-frequency manner. You wouldn't do that lots of times, unless, of course, it made money, unless you might try and do it lots of times. So I think high-frequency trading is a misnomer. If you take nothing away from this, then perhaps you'll say high-frequency trading less. Automated trading is very much here to stay. Risk-taking is very much here to stay. And risk mitigation is very much here to stay. So in my opinion, that there isn't much that has changed over the last 15, 20 years. A bit like John was talking about, content is king. People still make the same trading decisions. It's just a different way of them executing. And for my money, a better way. That's all I have. Thank you.